The truth about Constellation Brands Inc. Or stars. These guys are really cool. Some of you guys might have heard about the stock. Not heard about the stock. My dad showed me this stock because he loves beer and stuff. And Constellation Brands, basically they own they own a lot of things. So they got wine companies, they have beer companies. They have a lot that they do. They own, I think, over 100 different companies. They're invested very recently, and most notably, or well, I guess more publicly, they were the big company that put billions of dollars into Canopy Growth, and but really their core business is beer, wine, and spirits, and that's kind of what they do. Is they just make alcohol and they sell alcohol, and that's sort of their go-to. And they own basically some of the really a big collection of the biggest brands that exist anywhere. They're really, really, really big, and it shows because if you go over here, first thing you're going to see is their market cap's about $24 billion, which is it's a lot of money. And so these guys are sort of well established. They went public in '92, so give or take 3 decades ago, and they've been chugging along selling alcohol like no one's business. Really took off in I guess the kind of last decade or so, which has been really, really impressive. And so the question here is can this continue? Is this growth reliable? And what are the long-term prospects for this company? And are there any trades to make, or any swing trades to make? And are there any plays to do on this stock right now? Now that they've had this massive dump. And so we'll kind of uncover that here, which I'm kind of really, really excited about. So if you go over to Yahoo Finance, first thing you're going to see is their revenue is pretty solid. They do about $7 billion, $8 billion a year in top line, and they have really nice margins that have been growing pretty consistently. So they're doing about 30 or 40% of their revenue is turning into just straight cash for them. They do stuff in the U.S., but they're also international. So they got Canada exposure, Mexico exposure, New Zealand exposure, Thai exposure. These guys are all over the place. Everybody's buying beer, it's not, or alcohol, and so they're not really centralized in any central country. So you have a little bit of international risk here, but you also have a little bit of international diversification. So it's pretty nice. As long as shipping is still okay because of the virus, they should do okay. Obviously they've had a bit of a pullback since global recession, all that stuff. But everything else about them is pretty solid. Their PE is 28, which is pretty reasonable. They're pretty correlated to the market at about a 0.77 beta. And that's kind of the big takeaway here, just at first glance. Now what's cool is if we take a look a little deeper under the hood, we look at their financials, the first thing here that I really, really like is that their market cap has been growing pretty slowly and consistently. And so it kind of goes up and it kind of goes up, and it's a nice gradual curve. And that's cool because when you have an overarching metric like market cap or EV, you want to see the value of a company generally go like this. And this is super, super cool because if you can make this happen for a long enough time frame, in most bull markets, what will happen is if this is the actual value of the stock, this is the market value. If we draw this as market value and it's sort of consistently going up, what's cool is if we look at the actual stock price, the stock price will, in most scenarios with most public companies that are sort of as long as they're recognized by any account of their brand name, usually the stock price will kind of go like this. And so at the beginning it's kind of close, but then it starts to really, really, really take off. And that's kind of what we have here with Constellation Brands, is their stock has basically done this while their market value slowly, gradually increases, which is really, really good. In the short term, you make a bunch of money buying here and selling here. I mean, there's no doubt about it. This is a phenomenal, way to look at your investments. But in the long term, you kind of have a little bit of a downplay because eventually you're going to see the thing come back to its actual market value, and usually it'll go below it for a little bit before it cycles, and then it repeats the cycle all over again, which is totally okay because once you know that this is going on, you don't have to freak out when there's a pullback, and you can just trade it like any other market cycle, trade it like any other business cycle, and it's not a big deal. And that's kind of what we have happening sort of more recently with Constellation, is they're kind of coming back to their core, and you can tell pretty easily. First of all, by looking at their PE, the PE's gone from 20 to, I guess, it's gone from 10 to 45, which is almost 50. So the PE's basically quintupled in 1 year, which is kind of a lot. And so that's kind of one of those things you're going to see where, they've kind of got to come back down a little bit. And if you look at their book value, Your book value right now is about 61 a share. So, considering that they're at 124, it's not that, that's not crazy. That's a pretty fair multiple of book value, to be honest. But considering just the global conditions we're in right now, we're going to start to see, they were at, 215. So that book value is really going to kind of act as an anchor for the actual underlying value of this company if they do sort of come back down towards that. And that's going to be influenced by a couple of things. The first thing is their payout ratio. So they pay a 2.2% dividend, which is really, really sweet. It's about 70% of their net earnings, which is getting paid out. In 2008, they still didn't really have a dividend. They started paying dividends about, 7-8 years ago. Or I guess that's not that long ago. But basically, my point is they haven't really had a dividend during a recession ever. They just started paying dividends. So there's really no telling whether or not this dividend is going to stay in place. And that's risky, not necessarily because of the dividend rate. I mean, it's a 2% dividend. The stock moved 7% today. It doesn't matter. But the risk in this is that if they stop paying dividends, it's probably in the short term going to really, really hurt their stock. And if they stop paying dividends, I honestly, with pretty high levels of certainty, these guys will have about 2 years where they just slump around. Maybe 1 year conservatively, but I mean easily 8 months where they just slump around. Because if they stop paying dividends, usually when stocks stop paying dividends, in the long term it might not matter. In the long term, they might, they say they pay a dividend here, and a dividend here, and a dividend here, and a dividend here, but then they stop paying dividends because there's a market crash. As soon as they stop paying dividends, people are going to dump the hell out of the stock because people are stupidly obsessed with dividends. And then once they start paying dividends again, then it'll go way back up. So if they stop paying dividends, I would, in the short term, get the hell out of the company. And as soon as they start paying dividends again, that's going to be a really, really nice opportunity to go whoa, something's going on here. They're paying dividends again. And that's usually when you're going to have something like a MACD crossover. And I think that's going to be a really influential thing on this trade too, where you have that MACD crossover, and then they start paying dividends again. And then this is going to be a really nice time to buy, especially if you're going to hold that for the long term. It's a really solid play there. And so that's kind of the story here with just basis. The basis of coming into Constellation is they're in a little bit of an interesting pickle where they haven't really been doing what they're doing right now ever. They've gone up a bunch before. They've gone from $20 to $10 before, but they've never really been in a situation where they're really hyperinflated, way above the monthly moving averages by a factor of 3 or 4, and actually paying dividends. So we'll see how that works out, because if they cut the dividends, that's really going to hurt their equity performance. With that said, though, their quarterly earnings growth is phenomenal. It's 20%, which is awesome. The revenue growth is not as awesome. It's only about 1.4%. So you got to think about what's the saturation in the general alcohol market. And so for these guys, I mean, they basically dominate the market pretty well. I mean, Anheuser-Busch might be behind them, but they're really kind of one of those pioneer leaders, especially in wines and spirits. And so, how fast is that market going to grow is the question. And the answer is actually a little bit easier than I thought it was going to be. So I did some very in-depth research and looked up alcohol consumption during recessions and did a little bit of difficult mental common sense to figure out that people drink a lot of alcohol when there's an economic recession. And that is shown by this very in-depth and detailed graph right here. And so what's cool is if you look at what these guys did in 2008, they obviously had a decent pullback because the whole economy kind of hit the shitter, but they recovered pretty quick. I mean, this is probably one of the faster recoveries where in this matter of 2 months or so, maybe 3 months, they went from 10 to 17, and that's a really nice recovery time. And then after that, the growth was huge because people got addicted to their alcohol. They got hooked on it. And then afterwards, they had a lot of long-term growth because of it. So I think what's cool is when we look at this company, you got a lot of people right now with the start of a recession that are going to get into drinking for sort of the first time and then get hooked on drinking for the first time. And that's sort of where the money is here with Constellation Brands, because you get a lot of people that sort of start off and they're sort of abstaining from alcohol, they're not drinking or whatever. And then they have this event in their life, let's call it a stock market crash, that really, really stresses them out. And so they start drinking. And then, there's a percentage of these guys who are just going to be, if you guys didn't know this, there was a study from Schultz, I think it was 40 years ago, and what Schultz figured out was that 80% of the money that they got from their sales. Schultz is another beer company. 80% of the money they got from selling their beer came from only 20% of their clients. And those 20% were the people that were drinking like, a couple of beers a day or a case a day or something like that. And so what's important is not necessarily a bajillion people getting addicted to alcohol. What's important is a bunch of people try it, and then you have a small percentage of these individuals, call it 20%, that lead to 80% of the long-term profits for this company, for this alcohol brand, right? And that's really where your money is with this company, and that's really where the game is here. Is you get a bunch of people freaking out about the market crash, and then these guys go and start drinking heavily because during recessions you have a really big increase in binge drinking and a really big increase in frequent binge drinking, and that translates itself into a good chunk of these guys that get hooked on alcohol, and those guys that get hooked on alcohol are what increase the average shareholder value for the company as a whole, and in the long term increase its overarching growth prospects because they have a dedicated client base. They're going to leave tons of cash flow and therefore fuel really big growth curves like this. That's the big cool thing about Constellation Brands. Yes, these guys are going to take a shit when the market goes down, like they have been already. But in the long term, this is a pretty nice little opportunity for them to grow their underlying core business. And like we said earlier, these guys are not just one company, not just one brand. They are one company, but they own so many of like the people in the vodka space, in the liquor space, in the wine space, in the spirit space, in the beer space. They own high end, low end, mid tier. I mean, they own almost everything in the space. And so there's almost no escaping it. Like if you're going to drink alcohol, there's a phenomenally high chance that you're drinking something from Constellation Brands, and thereby fueling this growth curve, this self-fulfilling loop. And that's really powerful. And one of the cool things about this stock right now, which is really cool. So that's sort of why their quarterly revenue growth might not be as important as like servicing their existing clients or to give them a bulk of their profits. And that's really where a bulk of the money is going to come from, which is really cool. If we look right now at the short percent of float, it's pretty small, about 3.5%. It's kind of average, what I would kind of expect for any company ever. There's nothing too outstanding about that, nothing too crazy about that. 3% is pretty reasonable. A lot of people think it's going to go up, a lot of people think it's going to go down, and that makes sense. It's kind of at a mid-ground right now. It's at the 100 monthly moving average, and so the question is it going to keep dumping, or is it going to come back, or what's going to happen? And that's kind of what they're trying to figure out right now, which is totally cool. And so that's kind of about it for the key statistics. There's not much else to look at here, except for, I guess, a big chunk of the stock's held by institutions. So, if the institutions sell it off, then you're going to get hurt. But I don't think that'll happen so much because this is a really well-diversified company with a lot of sub-brands. So it's going to look like a nice hold for institutions, even through a market downturn. You've got a really nicely diversified company. Not in terms of like correlation. Like if you think about it, like basically everything this company does is in the same little box of like alcohol/drugs. Even though like if you think about it, right, they have like 100 different companies. Well, each of these little people could be like the CEO of one of the companies. They got like 100 different companies, and all of these companies have their own little reports, and they all have their own statistics. They all have their own financials. They all have their own accounts. They all have their own products, and they all do their own thing. And this is a fallacy that I see a lot with new investors looking at like their diversification for their portfolio. And so they'll buy like 100 different stocks, and they'll all be separate stocks. By all means, Nvidia and AMD are totally different stocks. But what's interesting is because these are all in the same like box, they're very highly correlated, right? And so I see a lot of investors, they say that diversification is important, and they think it's important, and so they go and they buy like 10 tech stocks, and they think, oh, okay, I'm diversified. And I'm like, dude, you're like, no, it doesn't work like that. And it's really critical when you're starting out, because when you're starting out, you don't really know what you're doing, and so if everything is in the same industry, and the sector goes down, then the diversification is pointless because everything is going to follow the same general trend of whatever the market does, whatever the sector does, whatever the space does. And so, you can own like 50 tech stocks, and if they're all freaking tech stocks in the exact same industry, you're going to have a portfolio that looks exactly like the NASDAQ, and you're going to have zip in terms of diversification. And so it's really critical, I guess, in your long-term portfolio construction, to have really non-correlated assets, right? In a perfect world, you would be trading sort of in this mystical land where, you're buying umbrella stock and you're buying, I guess, sunscreen stock. Now remember, this is one of my favorite examples ever. So you have, umbrella stock that goes up a bunch when it rains, and then down a bunch when it's sunny, then up a bunch when it rains, and blah, 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 blah. Then you have your sunscreen stock, which goes down a bunch when it rains, and up a bunch when it's sunny, and down a bunch when it rains. And then in the long term, really, really simple little formula here, you add the two together with a 50-50 weighting, and your portfolio goes straight up. Why? Your portfolio goes straight up because you weren't investing in a bunch of stocks that were all correlated to go down at the same time, or all correlated to go up at the same time, or all correlated to go down at the same time, et cetera, et cetera. So you can remove a lot of the inherent volatility in your portfolio just by kind of focusing on having non-correlated assets. And so, long story short, that's kind of the situation we have here with Constellation Brands. Is yes, they own 100 different companies and they run 100 different brands, but they're all basically in the same bubble of alcohol, right? Or alcohol / drugs. I mean, some of it's in cannabis, some of it's in other stuff, but most of it, both the profits come from alcohol. And so the question is, so anyway, my point being that these funds that are holding it and they see it as like this quote-unquote diverse pick, they see this as a diverse pick because of pure quantity, like it's a very high quantity of companies here, but at the end of the day, really what you're looking at here is a lot of correlated assets. So the diversification here is not going to be what like a lot of people think it is when they say, oh wow, they have so many different companies. Because really, when you can think about it, like if a beer stock is going to go down, then more than likely a vodka stock is going to go down. Or if sales are going to decrease for wine, more than likely they're going to decrease for beer. And we'll get to the report in just a moment, and it'll break down some of the nuances of that statement and some of the nuances of this trend, but most of it's going to be pretty closely related. It's not going to be that big of a play on diversification. It's not like you're buying an ETF here, because you're not. You really aren't. You're buying a company that makes a bunch of alcohol really well and sells it like hell, and they've done a phenomenal job with it for over 40 years. I mean, it's just crazy cool stuff. And that's kind of the big takeaway. Before we get into the financials, I wanted you to understand that concept about the diversification of stars, because it's going to make a really big impact on how the stock reacts to the market trends, more importantly, its overarching long-term growth prospects. So, with that said, let's go over to the financials. And what we're going to see here is super good. All right, we got increasing revenue. They're making like $8 billion in top line, and obviously they have costs. If we look at their margins are about 7%, which is, their return on equity is 7%, so they have pretty nice return on equity and stuff. But the profit margins are 10%, their operating margins are 30%. That's really solid, especially for somebody in the food space. Look at companies like Tyson, and you're looking at margins that are a lot thinner than that. And they're sort of similar, right? Like Tyson sells bulk food, Constellation Brands sells bulk alcohol, and so really nice to see higher than normal margins. Alcohol as a whole, my parents used to run a restaurant, and alcohol is always just consistently over and over again the number one thing in terms of margin. Like you can sell food all day and make 10% margin, but you sell alcohol and you've got like 100% margins. I mean, the margins out on alcohol are just insanely high. And so here's a company that sells more food, like Tyson sells like hard food, and they got like a 7% margin for operating. And again, remember, Starz is at 33, or 30%. Which is about a 5 times greater margin, which is really good. Because again, alcohol just has absolutely phenomenal margins. It's one of those profitable things you can sell in a restaurant. Really good margin on them. So here's sort of the numbers for that. They make billions of dollars a year, which is awesome. You have, I guess, selling stuff, which makes sense. Operating expenses. Most of what you would expect with any normal company ever that exists. If you look at their balance sheet, you're going to see a pretty similar story. It's not too difficult. Basically, they have a couple million in the bank, a couple $100 million in the bank. They have a lot of receivables, and then they have a lot of inventory. So this is just inventory sitting around. like I guess boxes and kegs of wine that haven't been sold yet. They're about a $24 billion company, so to see them have $2 billion in inventory isn't that's not that bad. It's not that big of a deal. I don't usually like to see a lot of inventory, but considering that, they're a $24 billion company doing $8 billion a year, $2 billion in inventory doesn't seem like it's too out of the ordinary. It doesn't seem too crazy. It should be a-okay. Yeah, that's like what, I would say 8 billion a year divided by 10 is about 0.8. That's like maybe 3 months of inventory. And I think that's fairly reasonable, especially considering sort of economic times right now. It's good to have a little bit of build up just in case they aren't able to operate a factory somewhere because of people that have to stay home sick or something like that. So it's good to see they have a little bit of inventory, but it's not like a crazy amount of inventory. I wouldn't want to see anything over like probably 2.2 billion, or 2.4 billion, which is about 10% of their market cap. Next thing we're going to see here is they have a bunch of plants and a bunch of property. I guess this is like how they actually manufacture their product, which is super, super cool. Obviously, very, very necessary to have a functioning company is, you have the facilities to make the thing, and obviously that's what they do here. And a lot of goodwill. I'm not exactly sure where $8 billion in goodwill comes from, but I'm sure they have a phenomenal reason for it. And probably their brand names, stuff like that. Tangible assets are going to be recognized there too. But besides that, not much else to see here. Long-term debt's about 11 billion, which is fine considering they make like $4 billion a year. They can pay that off easy if they wanted to. Stockholders' equity is positive, which is awesome. Everything else here looks really, really solid. The revenue, everything here is pretty solid. If you look at the cash flow, we're going to see where the money's actually flowing in the company. And first thing we're going to see is, first of all, like their net income is like literally billions of dollars, which is phenomenal. They're depreciating stuff like no one's business. They have tons of working capital. And really, it's a very, very, very cash-rich company. And that's great because if they start to have that fall, if they start to have that crash, they start to struggle, you're really going to want to see a lot of cash in the bank to help them sustain themselves for a couple of years. Yeah, so their operating expenses is like $4 billion a year. So to see them, sitting, and I'm sure a bunch of that's based off of their sales. So to see them, kind of having a couple billion in the bank and a couple billion set aside and some money left over, it's really going to be nice. A lot of working capital here that's going to empower them to stay afloat. If they do have any troubles, it should be a-okay. Like they're a solid, well-financed and well-managed company in terms of cash flow and money flowing through the company, which is really, really super cool. Probably the two biggest things we're going to see here in terms of expenses are debt repayment and dividends. You're looking at about 2.5 billion per year for those two right now. Last year the debt repayment was a lot less. The year before it was a lot more. So that might change, but I'm going to call this about $2.5 billion. So that's where a bulk of this money is going from the revenue. You got about 8 billion minus 2.5 billion is about 6.5 billion, and I'm guessing the other 2 billion go to actually producing the products that they sell, which totally makes sense and is really, really reasonable for these guys. It just works really, really well. And that's kind of the story here when you look at the books. It's a pretty well-managed company. They got a lot of cash, and they're just doing really well, which is phenomenal, right? Super cool stuff. If you take a look at the report, you're going to see a lot of the same things. There's a lot of very, very responsible stuff here. They basically talk about how they're working together and they love everybody. And here's sort of them talking about how their categories changes, like their sales have been changing. And so you can see a decrease in low end, a decrease in high end. Not that big a deal. Fluctuating economies. What's cool is, economy goes up, people buy more expensive things. Economy goes down, people buy less expensive things. And Constellation Brands owns both of those. They own the high end and the low end, so they kind of get like all of the money. It also makes it less of a volatile stock, which means it's not as solid for most swing trades, which is totally okay. We're gonna look at that in a second, but it's cool to see here that they kind of own like everything. So like if you want alcohol, you kind of have to go to them. Talks about some stuff here about the executives and basically how these guys are the #1 grossing alcohol beverage company on the planet, and how they make billions of dollars, which is super, super cool. And then here's their 10K. Pretty basic stuff here. They got a couple classes of shares. The voting, like honestly, not that big a deal. They talk a lot about their risk factors here at the beginning, just because it's alcohol. I don't know. People don't drink alcohol. That's the risk factor. It's not that difficult. And obviously international trade because they have to ship it to a bunch of places. But the margins are so huge that it's like kind of easy to make that work. So yeah, you got 5 billion in beer, and then another 2.5 billion in wine, and about 300 million in spirits. So bulk of their money comes from beer, and then I guess half as much comes from wine, which is great. And you're going to see that kind of develop through. These are the brands they own: Corona, Modelo, other import brands. Like, they basically own a lot of these beer companies, which is super, super cool. And then here are all their wine brands. I mean, there's just a lot of stuff here about the overarching company. I guess they own, 7 Moon Black Box, and then some other big ones like that. I know, and then Savedka, they do a good job with it. It's not like that difficult. Talk a little bit here about like their corporate headquarters and government regulation. Basically say, hey, look, if the government says that people can't drink alcohol, then, that's going to hurt our money, right? Which is pretty obvious, right? Talk too about the seasonality, and basically they say that, the beverage season is seasonal. And here's kind of an interesting line that I thought was really cool. They said the beer sales typically are highest during the first and second quarters of the fiscal year, which is spring and summer in the United States. And then wine and spirits typically the highest during the third and fourth quarter during like seasonal holiday buying. And so basically they sell beer in the summer and they sell wine in the winter. So like we said earlier, they basically own everything, which is going to really decrease their volatility and make it a lot better for a long-term position, a lot tougher to pull off for a swing trade. And so I thought I would look at the stock after seeing that line, and basically just looking historically at these guys, they don't look like they have seasonality. Like if I'm looking at this stock right now, and I'll kind of zoom out a little bit more towards the past so that it's a little bit easier to see. But there's pretty little. They have a peak here in the June, I guess. Then they have a peak here in June, the 5th month of the year, and then they have a peak here in the winter, and they have a peak here in the summer, and they have a peak here in the winter, and then they have sort of a peak here in the summer, and they have a peak here in the winter, and they have a peak here in the winter. But I mean, all in all, like, this isn't a very seasonal stock because they are so well diversified in terms of like the sector that they're in, that they really track the overarching alcohol sector more so than the beer or the wine sector independently, because they freaking own everything. And so most of the peaks and the troughs you see here are not necessarily based off of the alcohol industry. They're really based more off of just movements in the overarching market, like with the SPY and with the overall market. So you're not going to see a lot of independent deviation from season to season, unfortunately, which would be cool to see that, but you just don't see that. And the reason why is because they do kind of own everything. So the market goes down, they're going to go down. The market goes up, they're going to go up. We talked about this earlier, but basically, they got a beta of 0.7, so they're going to follow the market, beta of 0.8 almost. That's kind of what you see here. Then they talk about the executives. They talk about, a little bit more about the company information, about how they don't want it to be illegal for people to drink alcohol, and how, weed is legal, but they invest in canopy growth, and so, they need weed to get legal so they can make a bunch of money on that investment, which, again, is a very small investment. And a company with 100 stocks, 1% of their portfolio or 2% of their portfolio is in, like, the weed industry, so not as big as most people are making it out to be. Besides that, they've got a lot of the acquisitions they made, which is cool. It's still part of their business. I mean, they're just reasonable company management here, nothing too out of the ordinary. They talk about where their breweries are. Most of them are in, I guess, the U.S., and some of them are in Mexico. They lease some of them, they own some of them. Glass gets produced in Mexico. I mean, it's just international trade here. Obviously, this is going to be impacted by like international tariffs and tariffs on Mexico, and trade between those guys is really going to be hurt. So if tariffs go up a bunch, these guys are going to have a little bit of hurt in that regard, and that's going to be something that's going to sort of suck. Most of their wineries are in California, and a couple in Washington, and then a bunch, well, I guess not a bunch, like probably like a third of them are in Italy, which kind of makes sense. That's basically what you would expect from this. So, all in all, if international tariffs go up or if trade becomes more difficult internationally, these guys are definitely going to hurt because of it. And I think that's one of the reasons why the stock has gone down so much lately. Among other reasons, is because like if they can't ship their product, then it's really going to hurt their public perception and thereby decrease the stock price pretty hardcore. And that's kind of what we see happening right now with these guys. But besides that, not much else here. All in all, bulk of their business is just selling wine and beer, and that's basically what we just looked at. Everything else here is going to be kind of like some of the financials that we've already been through. And just talking more about the segments. It's a pretty basic kind of common sense thing. You sell beer in Canada, and as long as people keep buying beer or alcohol or wine, then they're going to make a bunch of money, because they're literally making like billions of dollars hand over fist, because they're just selling like some magical alcohol, and it freaking works, and it has worked over and over and over and over and over again for decades, and they do a great job of it. Talk a little bit about their international credit risk, just because they do sell things internationally, so they are going to have a little bit of that international credit risk. Thankfully, with rates going to zero, that should kind of be minimized. The other thing that would be a big deal is like international currencies. With the deviation between the euro and the pound, I think the pound's down like 7% this week or this month, so that should kind of help them a little bit. I'm sure they're hedging against it too, so not that big of a deal. Really, it's not that big of a deal, because they just have such big margins that like help. The pound could go down 30% and they would still have like phenomenal profits in Europe. So not that tough to make it out here. Here's a lot of their debt. Most of it's about 4%, 3%, which is pretty low for a company. That's a pretty damn good rate for a corporation. They have a really low cost of debt here. Most of it expires. I guess a lot of it expired last year, 2 years ago, 3 years ago, and I guess it's based on LIBOR, which is good. But if you look up just their WACC real quick, and this is going to matter because again, a lot of their the buildings that they lease out, or the buildings that they rent, or the ones they actually own to produce their product, is going to be based on debt. So it looks like they're at about 7.5%. So I guess some of that stuff on the report was a little bit lower, just because it was from like last year, or 2 years ago, 3 years ago. So they're paying about 7%, and that is totally okay. And the reason why it's totally okay is because if you look at their statistics, like they can take money in at 7%, and then their average return on capital invested, their average return on equity is it's about 7%. So like they're taking in the money and they're kind of keeping it with the same amount of money, and then they turn that into a product, and their product is worth a bunch of money, and that's really the game saver here. And the change is because they just have great margins, and so they can take on a lot of things because they have great margins, and that's really the biggest thing that matters with these guys. As long as their margins stay high and there's not a lot of international competition, or not really any competition that's really taking their business away. Obviously there are people that compete in this space. There's a lot of peer companies, but they have a pretty established reputation, an established brand that has an established amount of value that people will pay for it. So you don't see much of a risk in terms of, the only thing that could really screw them over is if there's a bunch of inflation and people don't want to pay as much for beer. But really, I don't think that's going to be that big of a difficulty, just because demand increases as markets kind of fail, just because of stresses, pressures, and stuff like that. This looks like a pretty freaking safe, or a pretty solid underlying. And then that's kind of the rest of the report. There's not much else here. Here's the performance graph. They've been doing pretty well versus the market. Super cool to see it. Different classes of stock, they perform basically identically. Definitely really crushing the market until the recent giant crash where everyone exploded. The market crashed too, though, so they're kind of really matching the market, and their beta is holding true. It's a very highly correlated stock to the S&P, which is pretty sweet. And so that's kind of the big takeaway here with Constellation in terms of their fundamentals and their financials. So in the long term, it looks like a great company. These guys, they make a bunch of money. They are in a great industry. They dominate that industry, and they're only going to make more money as more people get into alcohol, and they just continue to grow their business. It's not it's pretty simple. The biggest risk for these guys probably is competition, and I don't think that's something that's going to be that big of a deal, because you have a really high barrier to entry into any kind of service where you're selling food or beverages to the general public, and that's exactly what they're in right now. If you look at the charts, there's kind of I'll pull it up on Thinkorswim because it's a little bit easier to see what I want to show you here. There's not much here in terms of VWAP or MACD or not VWAP, MACD, stochastics or RSI. If you look at the monthly, you're going to see basically, it's kind of oversold, sort of. There's not really a definitive cross in the MACD anytime recently, and the stochastics are just kind of hovering around 50 and kind of flopping around, which isn't great. You usually want to see it decisively move through 50 to either the upside or the downside really quickly. That's not what you're seeing here. So the stock's been a little bit indecisive in terms of technical indicators, but there's one thing about this company that I absolutely love, and it's the thing that actually got me into it in the first place, and it is its recent performance in terms of this gigantic, beautiful, beautiful, beautiful symmetrical wedge. And it's just been so good. So I'll kind of show you that real quick. The symmetrical wedge, if you don't know, pretty basic stuff. Basically what happens is kind of get your stock, and it doesn't matter where it starts, but it goes up, down, 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 down. And so you have your support line, you have a support line kind of curving up like this. You have a resistance line like going down like that. And the thing with this is that they're both kind of at the same angle. So neither one of them is really preference. There's not like a flat one on top, not a flat one on the bottom. It's not a downward wedge or an upward wedge. It's a symmetrical wedge. And this crossover point right here, and usually a little bit before this crossover point, is really where you want to get in a trade on this stock. This is where the action happens. And basically, right before this crossover point is where either the stock's going to go down, or the stock will go up. And that's really the question. Usually, the way it breaks out, like if it breaks out to the upside, it's going to continue to go up. And similarly, if it breaks out to the downside, it's going to continue to go down. And what's cool about the setup is it's actually super easy to set a stop loss. All you do is make your stop loss kind of like right where the cross is if you're aggressive, and a little bit, it depends, a lot of times it depends on like the actual price of the stock. So if this from we'll say we're on the buy side, okay, say we're buying the stock. If from like your entry point right here, which we'll get to how to identify in just a second, to the middle point right here, if this is like big, if this is like 10% or 15% or something, then sometimes you can set your stop loss a little bit higher, just to keep it safe. But usually you want to set your stop loss kind of like right in the middle here, because the setup will invalidate, not if it goes down, it goes up, it goes down, it goes up. The setup will invalidate if it comes back to this middle point right here. And if the setup goes wrong, like if it breaks out to the upside, you buy, and then you get stopped out here and it goes down. Both of the time, and I don't trade stocks I lose money on, at least in the short term, but both of the time, if it fails to break out, which happens, I would say 5 to 10% of the time, and it doesn't work, the reversal is going to be much stronger, and it'll continue to go down and down and down and down and down. But that doesn't happen too often. Really what you see usually is it breaks out to the upside, it goes up, or it breaks out to the downside, it goes down. And the way that you know sort of where to buy or where to sell is basically you just want to like take whatever this height is right here, we'll call this like H, and you kind of just want to like take like a third of that, give or take, and kind of add that to like sort of if you're looking at this, you want to just kind of split it in the middle, kind of find the middle of this curve, then add like 1/3 H to that, and that's kind of where you get sort of your target entry point. You want to have it in a place where, like if the stock gets there, like here we'll look at with Constellation, right? Like if the stock, and here's kind of the wedge, okay? Like if the stock gets here, like that's kind of the point where look, this is breaking out to the downside. If the stock gets here, this is the point where you kind of know that, look, the stock is breaking out to the upside. And so you'll get better and better and better at finding those price levels with experience. It's really not that difficult. You just kind of do it off the top of your head. But you just want to look for a point where, like, once it gets here, you can tell that it's going up. Or once it gets here, you can tell that it's going down. And most often, it's a good place to start and a good place of reference. It's usually about 1/3 of the height of the initial run-up. And so here, if we were looking at using that, simplified logic, what you would do is really, really easy. We'll do some way. You take kind of this height right here, take about 1/3 of that, so I guess this would be like 1/3, this would be another third. Kind of take whatever this third is, and I'll kind of do some quick finger math here. I'll kind of add it right to probably like right here, and that would kind of get us our entry point at about 160 on the short here. And that would be a really, 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 really conservative entry point. Like, I want to be honest, I would be shorting the hell out of this thing right here. Maybe right here if I'm ballsy. But if you want to be really conservative, that's sort of the strategy you can use, where you have about 1/3 of this height right here. Just kind of add that here to 1/3 height. Add that height to the like middle point of this. This was a little bit of a longer setup that kind of started out way back here, but it didn't have a bottom way back here. So like the true middle would be like right here, but I used this middle point right here as a reference because it was kind of a more easy to access price. Like you can't really set it right at the bottom. Like you never want to have this right here. You don't want to have this like where it's at the top, right, or where it's at the bottom. You want it to be kind of in the middle of the bulk of the wedge, the middle of the body of the wedge, where it's like there's prices that are above it and there's prices that are below it. You're kind of in the middle of the pricing of the wedge. even if it's not the middle of the actual physical wedge in terms of time. And so that's what we saw here. There was like a bottom here, there's kind of like a top here, and this was kind of in the middle of the pricing of the wedge. And it created a really nice place right here to base that 1/3 height on, and then base your entry point on and further trade. And that's kind of the big takeaway here, getting into this position for what you want to see here. The target on this trade, really, really simple. You take this height right here, and you add that height, and I'll do some quick finger math. Kind of add that height to the breakout point right here. If you're aggressive, you can add the height to the bottom. It depends on what the ticker is. I know this morning, let me actually pull this up for you to show you, because it would be a lot easier for me to show it to you if I pulled up the actual stock. I was trading with Tesla, not Tesla, I was trading Tesla, but Shopify. And I remember I was with one of my students and I was doing some personal mentorship with them, and they made this trade based off of a symmetrical wedge, which is like the exact same thing I just showed you. And let me kind of snap in the snippet for you. We were trading it really early in the morning. The market, I don't know if you, like the market basically froze this morning. Like the market opened down 10%, and then all of the stop losses went off. The entire market was frozen forever, and then it was really, really a crazy morning. It was a really nice morning. But anyway, this trade came up here on Shopify, and we were trading options on these guys. We made about, I think, 45% on these guys today, which is pretty nice. I am always happy to have that kind of growth. I hope this doesn't get rid of my other snip, because I want to go back to my other snip, so hopefully this won't get rid of it. Please. Maybe I can do this. Aha, I can do this. Okay, cool. We're going to go back to like Microsoft snipping tool days, but it's going to be worth it. Okay, so there was this, whoa, you can't zoom in. Okay, that's okay. I can deal with, I can work with this. Can I get like a white pen or a blue pen? I can get a blue pen. Okay, so you got this symmetrical wedge right here. I'm sorry, this is really an interesting color. So you have this height right here, and basically what the strategy was, if I can, oh, is it going to do, okay, cool. So the breakout point was right here, and with day trade you can be a little bit more aggressive just because they're really, really active positions. So if you know that it's going to be an active position and you're really closely monitoring it, you can get in right at the breakout point and have pretty high confidence in your trade. So the entry point was kind of like right here. The VWAP's not on this trade, but I remember just from experience, the VWAP was kind of like right here for the day. So that yellowish line was the VWAP, and it kind of failed testing the VWAP here, and it was going kind of straight down after it failed the VWAP. So he bought the puts here, and basically, if you look at this conservatively, and you just take the height right here, and you add the height, just doing some quick finger math, that's basically going to give you a target of right here. And this is what would happen if you just took the height and you added the height to the breakout point right here. But for me, I knew that this was going to be a really active trade, a super active stock, and so what I did was, you know, I'm making the same trades because I like money, why not? And so, you know, I take this height. You want to do, you add the height to the actual bottom of the height right here. And I said, look, bro, target's 322, 322, 322, 322. And that's exactly where it freaking went to, was 322. And so it'll come to you more with experience, but basically you can add the height to the bottom of the height instead of the breakout point when you know that you have an active stock or stock's going to move a lot. And obviously be careful. Like for me, oh, sorry, I forgot I can't zoom in on this. I knew that if this candle right here closed green, this candle that I'm trying to like shade in sort of, if that candle closed green, then this entire setup would be invalidated and the stock was just going to go up a bunch. So I knew that like this candle had to close red, and it had to be a green, red, green setup for this to work, and that's exactly what happened. That's exactly what it did. You had a green, red, green setup, and it fulfilled the actual target that you got by taking the height and subtracting it from the actual pennant of the wedge instead of the breakout point. And so that's something you can do with a more active investment. That's something you can do with a more volatile investment, and you'll kind of get a feel when to do that. It's really hard. I was trying to explain this to my student this morning, and it's just a little bit, it's difficult to put in words. You just kind of get this through experience and instinct of trading, when to add it to the bottom of the H versus when to add it to the breakout point of a symmetrical wedge. But once you do, you're going to increase your profits by about 60% when you make your trade, which is really, really effective and super, super cool. So that's kind of the big takeaway with this setup. It's kind of weird. Look, I can draw this, and then it'll like come up afterwards. That's kind of fun. what you got here is a pretty nice setup where like they could hit, well, they already hit their initial target. So the initial target based off of breaking out of the wedge at the breakout point was right here. But like, to be honest, like the economy is entering a recession. The world's basically ending. Spy floats are up like 13,000%. Like I'm pretty confident that this thing could go to the target here about $100 a share pretty easily, just based off of this target height of the wedge here. Conservatively, not using this height right here, which would be super aggressive, and so that's why like there's probably a little bit more room to fall here. But this has been a really nice trade. I know my dad was in this trade, and hopefully he really crushed it, because I mean, just in terms of an equity play here, you're looking at a move from about 190 to about 100, which is about up. Let's see, if you short that, you're gonna make $90 on a $109 investment. So it's about a 45 to 50% gain in terms of straight equity. And if you look at the options on this, oh my God, so good. You're looking at, I would say 2 or 3 month trades here. So we'll look at maybe April's. If you pull those up, basically your premium for puts here, and you do the exact same, like remember, if this broke up to the positive side and the economy was exploding, you do the exact same thing with calls, or the exact same thing with buying the stock instead of shorting it. But anyway, the puts here are like $10, so you're looking at about a 9x return on your investment with this position, which is really just absolutely phenomenal. And so that's really what got me into, and what keeps me into Constellation Brands is these guys have a really nice, consistent setup over and over and over. And I hit 107 this morning, so yeah, I mean, $100 is not out of the question at all. Basically, the question is, I guess, like really, now that they've completed this wedge setup, which is a phenomenal wedge setup, what's next for Constellation? And for me, I think the answer is they need to consolidate. And they need to consolidate for probably like 8 months before anything really happens to these guys. There's like a 40% chance that they go to like $80 and they hit the bottom band here, the bottom 200 monthly moving average. If they did hit that, it would be kind of cool. I wouldn't be super surprised. I would be pretty surprised, because that's a really low target. But I mean, if you look at what they did in 2008, they went to that exact same price level. They lost, I don't know, 70% of their value as a company, maybe 60% of their value as a company. And so to see them go from 200 to 100 is a pretty conservative target. To see them go to 75 is an aggressive target. But if they did go there, what I would really be looking for in terms of a long-term play here is I want to see them consolidate for about 8 months, and then I want the MACD to cross over in a significant manner. It should hit like a crossover at, I think, -7 in terms of the monthly MACD, and that should be sort of a validating factor of them reversing. And the other thing I would want to see is, if you look at the weekly, really you're going to want to see these guys have a weekly crossover with these moving averages. You can see that right now the 50 weekly is crossing very close to crossing the 200 weekly, and I'm sure those are going to cross, and the stock will go down when they cross, because it's a death cross. And last time they had a death cross was in 2007, so pretty basic. They're going to have a death cross. They'll probably go down to like 75, maybe 80, I don't know, something around that. And they should bottom out. I want to see them consolidate for a little bit of time, maybe like a year, 8 months conservatively. And then all I really want to see is a MACD crossover on the monthly, and then I want the weekly 50 moving average to cross over the weekly 200 moving average. And give it about 4 months after that happens, and I think you're going to have a really damn good stock to buy. This is easily a $600 company in the next decade or so, and I mean, yeah, it's like not even a question. So, like, this looks like a really solid long-term investment. Once what I just said happens, where you have them go down, they have to cross again they have to have a golden cross in their weekly moving averages, and then you really just want to see a crossover on the monthly stochastics. And unless there's a technical setup, that's really all I'm really going to be looking for. The swing trade on this position is already long gone. It was about a 9x return, 12x return with volatility, and 15x return if it hits 100. And if it hits like 90, you're looking at a 15x return here. Phenomenal trade. Really great to see that. If you bought out of the money ones at like $20 out of the money, you're looking at a net return on this investment of I don't know, we'll call it, what $10 out of the money is 115. So that's about $6. So you're turning $6 into 80. That's about a 12x return. If you go a little bit further out of the money, like $15, $20, $25 out of the money, looking at $3, $4 calls, that's going to turn $4 into about 50. So again, about a 12x return on that investment. A really, really great company to trade. But with that said, now that they're kind of down a bunch, I think they should need to consolidate. They need to consolidate, and as soon as they start coming back up, start slowly drifting back up, this is a phenomenal company. It looks like a great long-term prospect in the alcohol space. As long as no really big competitors come in and they don't screw anything up and lose a bunch of business to their big competitors, this should be a pretty solid play to make, and one that can really do super well. Like these guys went in a matter of like 6 years from 20 to 200, and there's no doubt that you can leverage this with options. You do like 1 year call options on these guys. Once they do cross over, or even right now doing short-term put options could be a pretty friggin' nice idea. And really all you're going to be looking at in terms of premiums on those longer-term ones near the money are about $20 on a $120 stock, which is pretty reasonable for an entire year. It's not something I would take. I would just do this straight equity or short-term puts, because they probably will keep going down. Target on this, if you really want to get aggressive, is 75. And if it does that by like May 1st, you're looking at a profit potential here on this trade. I don't know, you probably bid on these, get them for $1 at 95. It's about $20 of value. You're looking to give it a 20x return on that investment. It's a pretty risky investment. It's also an investment that requires you to get a really good fill. Conservatively, I'd say you're looking at a $2 fill, which is going to give you about a 20x or a 10x return on your investment. If they can go all the way down here to 80, which, I mean, it could do it, it could not do it. Usually with these wedge setups, it's not going to go particularly much further than the H. Like, it usually isn't going to do like 2H, like a W setup or an M setup could. It's usually just going to stick with the height. And so, for me, like, them going to 80 is a pretty big fucking long shot, but it's also one that could totally happen if the market explodes. So I'm really going to be looking at plays on the market when I look at this position, and if it looks good, I might do like a quarter position on these guys with like 95 strike puts for May or June, with an $80 target, which is about a 10 to 20x return on those puts, and that's a really good reward. So I'd be willing to put it up, just assuming about a 40% risk on that position with a stop loss at 125, with a target entry point of about 112. And the reason why is because that's a phenomenal return. These options are extraordinarily cheap for a company that has so much international exposure during one of the largest international crises on the planet and one of the biggest pandemics that we've seen since Ebola. This position is very nice. These do have little volume. There's not a lot of volume on these puts, so the challenge really is going to be getting filled. But if you can get filled, and I'll try to get filled on these this week, or maybe next week, probably next week to be honest, then you're looking at some nice profit. You can get filled on this bid at a couple of dollars and have the spread here is like $2. And so if you look at the time of sales, what's cool is there is a pretty solid amount of sales here. So this is some high volume shit, and it's a really nice options chain because they're a very well-known public company. You're gonna have a lot of volume here, which is phenomenal. And right now I'm in KEM, and there's like no volume on it, even though it's worth like freaking 5-6 figures. There's no volume on here, so it's harder to trade. So these guys, with Constellation, it's going to be a much easier trade to make on the options. You got a lot of upside on the options. You got a lot of leverage on the options. Everything about this just looks freaking 10 out of 10. So in the short term, this is a great swing on the downside. In the long term, it's going to go up a lot slower than it's going to go down, because in general, markets tend to take a longer time to go up than they do to go down. Like the S&P goes up for 10 years and then it has a recession for a year and a half. So the downside, really, you're going to get a lot faster money and velocity of money in terms of being able to actually buy puts and make a reasonable risk-reward ratio on those. In the long term, though, this uptrend is going to take a longer time. It's not going to be as quick, I believe, as I drew it right there. So that's why it's going to be more like a portfolio pick for a longer-term investment. And honestly, it's a really solid play. And I think that's the big takeaway here from Constellation. Hey, this is John. I want to thank you so much for making it to the end of the video and hope you get a ton of value from the stock that we just broke down and hopefully learn a lot about them. Now, what's cool is if you have an investment that you think will look really nice, or maybe it's a potential investment that you're on the edge about, or maybe it's a stock that you're holding right now that you're just a little bit curious about, or maybe you want to get an outside perspective on it, what's cool is if you really comment down below with the ticker of the stock. I'll actually put it in Queen for a potential new video coming out. Now, make sure you also subscribe so that when those new videos do come out, or when these new stocks do come out, you'll be able to get, YouTube will know to send you the stuff, and if you click the bell, you'll actually directly get a notification so that you don't miss any of the new investments that we break down on this channel. Now, what's also cool is if you want to learn how to outperform 99% of investors and radically limit your downside, even if you can't pass a finance test for your life or have nothing to start with but a few spare bucks, I want you to open up a new tab right now, or go to a new browser, wherever you are, and I want you to go to stockmarketsecretsexposed.com. And inside Stock Market Secrets Exposed, you get instant access to a course I used to sell for thousands, a very, very high-level seminar I gave. The students literally go through and in their first month make 5 6 figures, and I can't guarantee anything, but I know for a fact that this stuff works, and it's gold. What I want to do is I want to give you this course I used to sell for tons. I want to give it to you completely for free, so you can learn the top 35 secrets that you can use within the next week to really, really crush your portfolio, really double it, and radically limit that downside. So if you want instant access to that, what you got to do right now is open up a new browser tab and go to stockmarketsecretsexposed.com, and I'll send it to you for free. Okay? Sound cool? Sound fair? Thank you again so much for watching, and I will see you either in another video on here or over in the master class. Thanks. Bye.